Welcome back for another top-notch video. This week, guys, we're going to be talking about the week of April 8th through April 12th. Was an interesting week. We'll get right into it. First of all, this channel is all about the CSI and F funds for TSP investors, or IVV, VXF, EFA, and AGG for those that have Roth IRAs or 401ks. This is a retirement channel about what to do with your retirement funds, what the markets are doing, kind of just a general overview, and just keep things interesting. The C fund or IVV represents the S&P 500. The S fund or VXF is the Dow Jones small caps. I fund or EFA is international markets, and the F fund is HEG. The F fund or HEG is bonds. That being said, guys, let's get right into kind of our general overview and then go more in specific about some of these stock charts. First thing we're going to be looking at, we're just going to be looking at the C fund to begin with. Kind of show some really interesting historical things about these charts coming up and kind of what we've done in the past couple of weeks. That being said, we've been kind of cautious lately, and the reason why is we like to look at history. As you can see, back in 2008, we had kind of a similar situation where we had kind of a decline in the fourth quarter of markets, and then we never did get a retest, or when we did get a retest of our 200-day moving average, we ended up having stocks move much lower, 52% lower. That is a big hit on your portfolio. So we were playing it a little bit conservative, and that's important. On this channel, we're just not going to buy and hold and buy. We're going to take a look at markets, and we might lose a little more percentage, but at least we won't ever take a big hit like 52% on our portfolio. So that's why we do that. And when you are mitigating risk, you don't get 100% of the return. So for that mitigated risk, we are not totally at the percentage that markets are at for this year, but we will continue forward with that cautious perspective. Okay, guys, this is the S&P 500 again, or the C fund. As you can see, I get a lot of people that ask me, well, if you missed some of the rally, it's too late, the rally's over, and that is definitely not the case. We have a lot of historical cases where after a plunge you have just straight up market action, and then afterwards you have that market continue to do very, very well. I'll show you that on a couple of historical cases. Here's one in the 50s, where if you would have put your money in after the thrust here of this plunge and thrust, you would put your money in right around A. There was still volatility, but if you would have held it in there for just a couple years, you would have seen over 100% gain of your portfolio, which is pretty incredible over just a 2.5 year period. Another case is in 2009. In 2009, if you would have missed out on this thrust here of straight up market activity after the plunge in 2008, you would have seen your portfolio over a number of years increase over 130%. If you would have continued on to 2018, you would have saw a 212% gain over just about 10 years, which is pretty incredible, guys. Doubling your money, tripling your money, which is just amazing from this plunge here. And you wouldn't have missed out on very much if you would put your money in here and stuck it through the long haul, through the rest of it. Like I said, when we mitigate risk, we do miss a little bit of this down here, but if we put it in here where we do on this channel, you can still make plenty of gain. That being said, let's move on. With what we saw with the S&P 500 on April 4th, we saw it, and this is why we were cautious, we saw it come below the 200-day moving average, and then basically MACD was not doing so well. It was negative for a while, and so we were very cautious with that, and it was 98 days below this line here, the center line. And then back on March 1st, it retook the center line and stayed above it for 5 consecutive weeks on the CiovaccoCapital management channel. They do all these charts, by the way, which is awesome help for doing analysis and stuff. You should definitely go check out their channel. I just use them here and there to show some things with the S&P 500 because the S&P 500 relates to TSP funds and IVV, but they do a great job with all of their charts, and I definitely recommend looking at their stuff. They get their stuff from stockcharts.com. But with 5 consecutive weeks above and 90 days below, they did a study looking at all these to see how many times it turned positive, and what their study found is 30, 60, 90, 180, 1 year, 2 years, and 3 years out of all the cases in history of where we've had a similar case where the markets fell below the center line and below MACD for 90 days, and then retook the center line for 5 consecutive weeks. What happened? And in all the cases, 2 years out, they were all positive. But since we look to a shorter term, 60 days out, only 4 of the cases were. And since we look to probabilities, those are very positive probabilities versus very negative probabilities for these charts. With that, we also want to look at things being from a bearish perspective, because we like to look at both perspectives, both very bullish, both very bearish. Now, if this was to be a major high and we never did retake the highs here, what could a drawdown look like? And why did we play it so cautious in early 2019? Well, a drawdown, if it was a 1962 drawdown like it was back then, it was a 27% drawdown, that would have taken us all the way past this lower low here, all the way down here. And if we go even farther, if it was a 1987 drawdown at 33%, it would have taken us all the way back down to somewhere around at the end of 2014. 2000 took us a 50% drawdown, would take us even farther. And then if we're talking about the financial crisis, 2007, 2008, we're looking at a 56 decline. This wouldn't even been just a blip on the radar compared to some of these other major declines. That's why we're being cautious. Like I said, you don't want to be a buy and hold investor when you have something like 2000 or 2007 hit, and you just want to be very careful with safeguarding your capital. If you miss out on a little gain, that's worth it for missing out on a massive drawdown on your portfolio. So we're happy with where we're at for this year, but that just kind of gives you guys some perspectives of why we've been a little cautious this year and what we're doing with our charts. So I hope that lays that into perspective for you. Also, going back to a bullish case scenario, whenever the markets have hit their 200-day moving average, 200-week moving average, we had a case in 2011, 2016, and now 2019. We've seen quite a rally off of that. So we saw that here. We had a great bull market. 2016, we saw that, and we had a great rally. And hopefully now in 2019, after hitting that and not going below it, just testing it, we'll see a great rally. So that's kind of a good positive sign. One of the reasons we were very, very cautious again was back in the beginning of 2019, only 10% of stocks were above their 200-day moving average. Now, we like to look at multiple stocks on multiple time frames because that gets us a net aggregate opinion of all market participants or everybody in the market. When you look at charts, you're looking at everybody that's in and out, the professionals, the non-professionals, the amateurs, the people that are good, the Warren Buffetts, everybody in the market. And so it's important to look at charts because that'll give you an overall picture of studying the technicals of what's going on. So when only 10% of stocks are above the 200-day moving average, that's the time to be very, very cautious. And only after 105 calendar days, we are at over 70% of stocks being over their 200-day moving average. So very, very positive sign in a very small amount of time. And when we had our pullback, when we pulled out around January 14th, we had only 30% of stocks that were above their 200-day moving average. We thought maybe we'd see a little more consolidation in here before we got this straight up rise. And now that we've had this rise and we see about 70% of stocks after a whole month period, we feel pretty confident here in April about reinvesting in our portfolio back into stocks with that, with such a bullish sentiment. Finally, one of our last cases were the S&P 500 or C fund. I'm sorry, a lot of analysis today on the C fund, but this just a general indice gives you a very good index, a very good idea of what the market is doing too. So these are our moving averages. Obviously, you can see them here on April 12th, where they're at, and it doesn't look anything like our bullish markets in 2000, 2008, or in 2015. Or I'm sorry, our bearish markets in these years. The moving average would kind of hit in the middle of the cluster, and then between that it would bounce off back and forth here and there, and then it ended up going lower in 2001. 2008, we didn't even retake all the moving averages, never got back above them. 2008 again, here's another good scenario where we didn't even get above our 200-day moving average, fell below it, and did not get back above it. Again, really, really nervous in here. In 2019, we ended up hitting these moving averages, started moving capital out just to see what would happen, and it just blew right through the markets. Again, a very good example here of the moving averages blowing through but then coming back in. We might see a retest here, but for the most part, this is a very positive sign. It looks much more like our bullish cases here in 1987, 2011, 1998, and 2016, where in all these cases the market moved above the moving averages where you saw here. Maybe saw a retest in here, retest, a couple retests in here, and then the market stayed above the moving averages and moved higher. So very, very good outlook so far for stocks based off of the data we currently have in hand. Now remember, stocks can do anything, so just keep that in mind moving forward. Lastly, what about our head and shoulder look that we've been talking about in the last couple months? Well, with the S&P 500, the C fund, IVV, basically we saw our left shoulder here, we saw our head here, and this is sort of like a right shoulder. And based off that right shoulder, we saw an extreme amount of growth. We did get into it just a little bit late. We would like to get into it just a little bit sooner, but we could see a great forecast from here moving on into April, after April, of how much higher we could actually go. But this is kind of what we saw with the S&P 500. And again, we're doing very well with our MACD and moving averages at this time. Finally, this is the value line for the geometric index. Basically, if you just like to look generally at general stocks, where the market is going, a very big indice. This is a great example. We take this all the way back to good old 2005. I'm sorry, 1995. And basically, we have the index here along with the trend line and a moving average. And basically, what we saw is in 1999, 1998, saw that hit some resistance here. Then in 2007, we saw some resistance here. And then in 2015, again, resistance. We bounced off the line here. And then we finally, for the first time in 1995 to 2005 to 2000, about 20 years, we finally got above this line here. Went above it, and we could say that this could be sort of a retest of this line before the markets tend to move higher. So just kind of interesting perspective as we move forward. That being said, let's go right into our markets and whatnot. Kind of a general overview after we talked about the S&P 500 for so long. So what did we see from this week from the TSP funds? Well, we saw a pretty good increase for the week. We were invested here in this area. We had a 0.5% gain from each of our stock indices. Saw a little bit down on the F fund. And then we don't talk about the life cycle funds, but C fund is IVV, like I mentioned before, VXF for S fund, and VXF for the F fund, and EFA for the I fund. So an AGG for the bonds. So this is TSP Talk. Tom has some commentary here. We just like to look over these few things over his commentary. He's pointing out that there are some open gaps with the S&P 500 or IVV C fund that the market might revisit. He's also noticing that these lines are starting to get a little closer and closer together, possibly seeing some resistance here in the future. With that, again, he's just taking a closer look at some of these gaps. There are 3 gaps for the S&P 500. Usually, from what I've seen in studying markets for the last 2 years, it does sometimes come down and fill gaps, but not always. So we'll have to wait and see. Since there's 3 of them, the more gaps there are, the higher the probability that it'll come and visit some of those gaps. So just keep that in mind. And as you can see here, he has a very good indice of where there might have been resistance with the charts. Wasn't a whole lot of resistance where he put it at, but as these things get closer and closer, we could start to see these things, start to see a little resistance here moving in. Because the blue rising wedge is never a good sign. But we'll go over that more specifically in our charts when I talk about that in a little bit. Other than that, he really didn't have anything too interesting to say. Looking at AGG, there was a large gap here. We'll see if that comes and visits that. But AGG is doing much better than it was in the past, so that's a good thing. We've been invested in that fund a little bit for the year, but not much. And then, of course, we have the Grow My Thrift Savings Plan, another really good site that we just like to look at. On a long-term perspective for the S&P 500 or C fund, things are doing pretty well. Off that 10-month moving average, we saw a big decline here again. We were very, very cautious. We are now above that again, looking for new highs in the market. And for AGG, like I said, doing very, very well. We saw some, I mentioned this last week, but some consolidation, 2008, 2009, consolidation, 13, 14, a lot of consolidation in the last couple years, and now we're seeing sort of a breakout. We'll have to wait and see where that goes. I could probably see this retesting this before moving forward. Seeing a lot of high volume. On the short term with the S&P 500, just watch those gaps up, but we see relatively big volume for the most part. We are above our 200-day moving average and our 50-day moving average. We have something called the Golden Cross, which is very good. And our indices and indicators, RSI, MACD, and Williams percentage R, are all very positive at this time. The S fund has a nice gap up. We've also seen the indices doing very well with the S fund. And EFA also had a nice gap up, but we have not hit that green yet for our indices. And we're waiting to see where that can move from there. Overall, that was kind of a general overview of our markets. And if we go into some of the more specific stuff, as you can see for IVV, like I mentioned, above all of our moving average, which is great, above our trend lines here. Markets seem to be doing very well. Just looking to maybe overtake those highs back in September to really get a confirmation that this is still a bull market and not some kind of consolidation or bear market or whatnot. So it would be really cool to see that. Markets have come a long ways in a very short amount of time. I mean, we're sitting up on the TSP funds. I mean, 16 and 19% just for the year, and we're only the first quarter in already. It's just insanity what markets can do. Markets can do anything at any time. That's the way I like to look at it. That being said, let's look at our charts in general for the funds. With IVV, we saw something very, very interesting for this week. As you can see, we're within our Bollinger Bands, but we did see the DO oscillator. It did go from 390 to 398 on a weekly perspective. That is a big deal. Usually when charts are declining, we like to kind of stay out of that, be careful, because when we had that last time and the time before, markets react to that and they tend to go down right afterwards. But now that we've had a weekly fake out, usually with fake outs, if I can find one for you on the charts when they do happen, good things tend to happen. We are up on the 2-day chart as well, and we are up on the 4 hours about to recross. So very, very good things for IVV going on. No complaints, no concerns. Good fund to be invested in at this time. The next one is the S fund, or VXF. Again, we are above our all our moving averages, which is really, really good to see. No real complaints or concerns with the S fund. A good 50-50 split, honestly, would be something to consider. If we move to our charts, looking at VXF, we are seeing some good things here as well. On a weekly perspective, the charts are a little more down. They're not up yet like the S&P 500. We're still blue line above the red line, but DO still declining, as you can see, from 30 to 20 there. So not as strong as the S&P 500 or C fund, but we did just get a cross on our 2-day chart, so that's something to look for and watch. Bollinger Bands are getting really close. Usually we see a big move when they start to get really close. Whether that's up or down, we could probably say at this point with the 2-day and the 4 hour both being positive that we could probably see a positive cross, but keep in mind the weekly is still on the downside, so just keep that aware. But things do look good for the S fund, I would say, as well. Of being above these moving averages is very helpful and very good and a positive sign. Even if we do come back and retest these moving averages, I'm glad that we're consolidating above them. Again, we were concerned in here. We kind of pulled out in here just based off what stock probabilities being above their 200-day moving average, like I mentioned earlier. And then we didn't really get just invested back here just yet because we saw a lot of consolidation within kind of our 200-day and our moving averages, but now we've broken above that now. Some successful retests here, and it looks like charts could definitely move higher in the future, or maybe do another retest, but good things to come for sure with those two funds. Moving on to our EFA, or I fund, international markets, we did see that breakout as well on a weekly perspective, not by much, so you might want to be cautious about that. But the 2-day is up, and so is that 4 hour. It's coming out. If we look at it from a chart perspective here, we are above our moving averages as well. We have not been above that 200-day moving average in quite some time for EFA, so that is very interesting to see. Could see some really good things happen with the EFA moving forward. Same goes for AGG or bonds, the F fund. we are starting to see, I think we saw a real bottom here in November, December area, way above our moving averages now. As it starts to test those, we'll wait and see where it goes. F fund on our charts on a long-term perspective is headed down, so keep that in mind. On a 2-day, it's heading down, but that's probably a good thing for stocks. That means stocks are the place to be at, and indeed that's where we have our capital at this time, and I'll show you that a little bit later on. That's kind of a general overview of all of our funds. Hope you guys kind of enjoyed that. Please like, subscribe, or share the video, and without further ado, we'll move on to where we are at and what we're invested in. So we moved some of our funds around. We moved them from the F fund about a week or so ago into VXF or the S fund. The reason we did that is because we saw a real good turn of events with those weekly charts. Another thing that we saw why we moved it into that S fund, one thing we don't like to do is bet against the market. We don't like to bet against all the market participants in the market. And with that, what indices we look at is some of the major indices, so like IVV, for technology we look at QQQ, and with IYY, we saw these charts start to decline early March, and we don't like to bet against everybody in the market, so that just tells us to be more cautious, play our portfolio a little cautious. It's kind of how we do things on this channel. Might not be how other people do it, but that's how we do it here. And with that being said, we were patient and we just waited it out, and sure enough, we saw a change in market participants this week. We went from 3.73 to 3.78. Very, very good things to come usually when we see a weekly fake out. Usually a rise for the most part. Again, 2-day charts are up for IYY, and so are the 4 hours coming out. And that's the net argument. That is the opinion of every stock out there with everybody invested in it. So that is a very good thing to see. Usually when I have an upturn in my weekly chart, that's when I start buying individual stocks again, because you can never be 100% right or wrong on individual stocks. And so when the indices, the major indice ETFs of all stocks or all of all technology or something is up, you have a better probability of making money in individual stocks than you don't. A little lesson on the side for our TSP fund investors and Roth IRA investors. If you are ever interested in getting into individual stocks, send me a message and we can maybe talk about it. But again, like I said, that is a very, very good sign for our TSP fund investors and our Roth IRA investors, for those that are invested in those ETFs or those funds. Again, this is where our allocation was for this week. I really do appreciate you guys listening and supporting this channel. As always, please like, subscribe, or share. And that's another top-notch video. We'll see you guys next time.